Good morning, everyone. Welcome back to ET Now. You're watching Market Cafe with me, Kanishka Sarkar. Over the next 1 hour, we'll get you top developments from India and around the world and also tell you about the stocks to keep on your radar. Well, first things first, let's take a look at the handover we are getting. With sharp declines on the Wall Street overnight, stocks fell sharply as a stock warning from Nvidia, Royal Global Tech, and concerns from Federal Reserve Chair Jerome Powell also about the economic impact of tariffs is what raised alarms among Scottish investors. Now, the Dow Jones Industrial Average lost about 700 points. That's more than 1.5%. The S&P 500 dropped more than 2%, led by information technology sector. The Nasdaq Composite, which is the tech-heavy sector, pulled back 3%. In fact, it ended the day about 19% off its closing high, which is sliding closer to the bear market territory. The shares of Nvidia sank almost 7% after the chip giant said it will post a $5.5 billion quarterly charge related to exporting its H20 graphics processing units to China and other nations. Now, in fact, the Wall Street stock slid to session lows during the afternoon trading after Fed Chair Jerome Powell said that Trump's tariffs could pose a challenge for the central bank. Now, Powell said during a question and answer session that levies could drive up inflation in the near term and are likely to move away further, further away from the US's goal. Now, since Trump administration first announced its reciprocal tariffs on April 2nd, the S&P 500 has slid roughly 7%. The Nasdaq is down more than 7%. The Dow, on the other hand, has lost about 6%. Moving on, oil prices also have risen more than $1 a barrel, Shreyansi.
Absolutely, that's the kind of handover that we're looking at, and it's been quite the roller coaster when it comes to oil prices, right? We've been seeing a little bit of a flip-flop coming in as far as oil prices are concerned. So a rise of more than $1 per barrel, like you pointed out, Kanishka, is what we're seeing. As far as Brent crude is concerned, you do have that about 2% rise coming in terms of percentage terms. Now you have $65 a barrel. That's the kind of level that you're looking at for Brent as well. And US WTI crude also rose more than $1, settled around $62 per barrel. And this hike, in fact, comes as the US has issued new sanctions targeting Iran's oil exports, so including against a China-based teapot refinery, and that is as President Donald Trump seeks to ramp up pressure when it comes to Tehran and also drive Iranian oil exports down to zero. Now, this is something that he had done in his previous regime as well in Trump 1.0. That is something that you also had as a key theme coming in. As far as oil prices are concerned, it was a very important factor. And it's an important factor yet again when it comes to Trump 2.0. And the action, in fact, comes as the US government has relaunched those negotiations with Iran over its nuclear program this month. Meanwhile, you do have OPEC. That is also a key factor. Also received updated plans, in fact, about Iraq, Kazakhstan and other countries to make further oil output cuts to compensate for pumping above agreed quotas. Now, that is something that was previously weighing on oil prices. Currently, you do have that helping oil prices at this point because they're trying to sort of balance it out when it comes to those production quotas that they had, that they decided to change. Now, you do have International Energy Agency as well that did slash its global oil demand forecast. And that is also something that is important. But on the other hand, you do have the yellow metal that also keeps shining brighter. And in tandem with oil prices, you do have gold also extending surge to cross $3,310 per ounce. In fact, it's very key to note that it did cross the $3,300 per ounce level yesterday itself with that record run that we saw coming in on the back of safe haven demand, given all of the tariff uncertainty that we have, Kanishka.
Absolutely. Now, moving on, let's get you some global stories. Well, in the first speech since Donald Trump implemented the 90-day pause on tariffs, US Fed Chair Jerome Powell, as I pointed out earlier, said that the central bank is staying in a wait-and-watch mode on interest rates, needing more data before making any moves. Now, speaking in Chicago, Powell warned that Trump's tariff tactics could raise inflation while slowing growth, creating a policy headache. Now, markets, he said, are reacting logically to shifting trade signals. With imports rushing in to beat tariffs, Q1 GDP may take a hit even as the economy and the labor market stay solid for now. This is what he has warned. Listen into that excerpt.
The administration is, as I mentioned in my remarks, is implementing significant policy changes, and particularly trade now is the focus. And the effects of that are likely to move us away from our goals. So unemployment is likely to go up as the economy slows in all likelihood, and inflation is likely to go up as tariffs find their way, and some part of those tariffs come to be paid by the public. So that's the strong likelihood. And my hope is that we'll get through this and get back. Well, we're always going to be aiming for maximum employment and price stability. That's what we do.
All right, then moving on. Now, here's something straight out of the Trump playbook. Forget spreadsheets, forget strategy. President Donald Trump says that he'll decide tariff exemptions based on gut feel, not data. You almost cannot take a pencil to paper. In fact, he also adds that it's really more of an instinct. Today, it's smartphones off the tariff list. Tomorrow, it could be semiconductors, and who knows what's next. For countries the likes of India exporting textiles, auto parts and tech hardware, this unpredictability stings because this is not just a policy, it's a shift away from a rule-based system. Let's go across and listen in to what Donald Trump had to say in his reply to the reporters when asked about the factors of determination when it comes to tariff exemption.
Yeah, go ahead, please.
Sir, would you consider exempting some U.S. companies, maybe some larger companies who have been hit hard in the markets the last few days during this 90 days?
As time goes by, we're going to take a look at it. There are some that have been hard. There are some that, by the nature of the company, get hit a little bit harder, and we'll take a look at that, yeah.
How will you determine the next 90 days?
Just instinctively, more than anything else. I mean, you almost can't take a pencil to paper. It's really more of an instinct, I think, than anything else.
Well, that's the word coming in from US President Donald Trump. Let's also listen in to Rajkamal Rao, who's the managing director of Rao Advisors, and his views in the global op-ed space.
For the first time, we are witnessing a truly executive presidency. I've never seen anything like it. There is a small team led by Treasury Secretary Scott Bessent, and Navarro, and we don't know where Navarro is, and Lutnick and a few others. But largely, this is a very, very closeted group of people. High-level decisions are made, and then Trump goes and announces them. So as regards how it will help or hurt India, this is where it is. Unless, India actually sends a high-level team to sit down, negotiate, and put these things down on paper, this uncertainty will exist for India.
Rather than moving on, the World Trade Organization has fired a warning shot. The global trade outlook has deteriorated sharply after Trump's tariff spree and escalating policy uncertainty, and after a solid 2024 where world trade grew nearly 3%. The WTO in fact now expects merchandise trade to contract 0.2% this year. That's a 3-point drop coming in from earlier forecasts as well. North America's exports, in fact, are set to plunge 12.6%. And things could also get worse if suspended. You do have the reciprocal tariffs that are enacted and trade policy uncertainty that spreads. World trade could shrink by 1.5%. The WTO also says that least developed nations will bear the brunt. What was also shaping up to be a global rebound now risks becoming a global rollback.
Next up, let's get you an update from the chip space. Now, AMD is bracing for an $800 million hit as new US export curbs block advanced chip sales to China. Now, a key processor is now restricted, with AMD saying it may apply for licenses, but there's no guarantee yet. Now remember, just as the day earlier, Nvidia also flagged a massive $5.5 billion charge under the same rules. Now China, which is a key market for both of the companies, made up nearly a quarter of AMD's sales in 2024.
Alright, then moving on, more warnings coming in when it comes to US Inc. Alcoa expects US tariffs on aluminium imports from Canada to cost the company about $90 million in the current quarter. Remember that their imports are subjected to 25% tariffs, which currently result in approximately $100 million negative for their business, and that's the word coming in from their CEO as well. In fact, the aluminium producer also said that the tariffs on Canadian imports had cost the company roughly $20 million when it comes to the first quarter.
Here's an economic update from Japan. Well, Japan's export growth missed expectations in March, rising just 3.9%. It's a sharp drop from February's 11.4% surge. Now, exports to the US grew 3.1% that is, but the numbers reflect only partial impact of the new US steel and aluminium tariffs that came into place. Now, remember, auto tariffs also kick in next month unless Trump makes a U-turn. And with that, cars making up 28% of Japan's US exports, bigger hits may be coming.
Rather than moving on, Japan is one of the allies that the US has been in constant talks with. In fact, Trump said on Wednesday that there's been big progress in surprise tariff talks when it comes to Japanese officials in Washington jumping into negotiations himself. Trump, in fact, expanded the agenda beyond trade, bringing up military costs and currency issues as well. Now, you do have Treasury and Commerce secretaries also joining the meeting, so that's an important meeting coming in, right?
That's right. Now, moving on, US Vice President J.D. Vance and his wife Usha Vance will travel to India next week. His office has announced. Now, Vance and the second family will travel to Italy and India from April 18th to April 24th. The Vice President will discuss shared economic and geopolitical priorities with leaders in each of the countries. That's according to a statement from the office of the US Vice President. Now, in India, Vance will visit New Delhi, Jaipur and Agra early next week. As per the statement, the Vice President will hold meetings with Prime Minister Narendra Modi. He and his second family will also participate in engagements at cultural sites. Now, the visit to India will be Usha's first time visiting her ancestral country as the second lady. That's as per a report in the Politico.
Well, absolutely. That's an important visit to take a look at. But tell you what, let's take a very quick breather on the show. When we come back, we'll get your check going on what the Asia markets are up to, so don't go anywhere. Welcome back. Thank you so much for staying tuned in. Well, a shift focus to earnings, then Wipro ADR saw heavy losses coming in trade on the back of weak first quarter forecast. Now, you did have an inline show coming in as far as Wipro's fourth quarter is concerned, but the tech major posted higher than expected profit in the last quarter of FY25 as well. It's largely the forecast that is quite disappointed. The company, in fact, said that it expects Q1 revenue from IT services business segment to be in the range of $2,505 million to $2,557 million, which translates to sequential guidance of 3.5% to negative 3.5%, that is, and negative 1.5% in constant currency terms. So that's largely what you're looking at. Quite the disappointing forecast that we have coming in. In fact, we do have Ansh joining in with more details when it comes to the numbers. Ansh, over to you.
So IT service revenue is up by around 0.7% sequentially to 22,445 crore as compared to previous number of 22,285 crore. If we talk about revenue in dollar terms, then we are seeing a down move of 1.2% from $2,629 million directly to $2,597 million. But if we talk about profit, then that has given a good jump as compared to previous quarter. We are seeing an uptick of 6.6% to 3,588 crore, which is above the expectation. Whereas if we talk about margin, then that is 17.5%, which is almost flat compared to previous quarter and in line with the expectation. Especially if we talk about booking, then total booking is up by 12% on quarter-on-quarter basis to $3,955. But if we talk about large deal booking, then this has seen a very large jump of around more than 80% actually to $1,763 million. Overall number looks good. Voluntary attrition seems to have slowed down from 15.3% directly to 15%. So this is also one of the positive points. So overall, large deal booking and profit has been extremely well in the company.
Thank you, Ansh. That's the fine print of Q4 numbers as far as Wipro is concerned. Let's listen into what the Wipro management had to say about their Q4 earnings and also the future plans.
The most important thing is what's happening in the macro environment, right? Today, in addition to the geopolitics, this year, macro environment in the context of tariffs has created a lot of uncertainties to our clients. And this uncertainty varies from country to country, markets to market, sectors by sectors. So if you look at it, the big markets that we have, which is the Americas and the Europe, clearly the clients there are going through uncertainties. Some industries, especially manufacturing, within that automotive and industrial, if you look at it, they are really impacted with what's going on. So first thing the clients would like to do is, how do I reduce my spend at this point in time when there is an uncertainty? In the another industry is consumer. They are getting impacted because how the inflation is going to be, how the consumer spend going to be, and so on and so forth. And I can tell you one example of a client where we're doing a large transformation program for them. They asked us to pause. It was not a cancellation, but it was paused because they wanted a certainty of what's going to go. We are continuing to see strong momentum in large deals. In Q4, we closed 17 large deals with a total value of $1.8 billion across our markets and sectors. In fact, for the full year, we closed 63 large deals for a total value of $5.4 billion, which is a year-on-year growth of 17.5%. Let me highlight two recent wins. One, a global technology leader has chosen Wipro for a major 5-year transformation program. Given the uncertainty in the environment, we expect our clients to take a more measured approach going forward, especially on two spend areas: large transformation programs and discretionary spend. The way I see it, the whole industry is seeing it. At this point in time, I want to say that GenAI is an opportunity for us. In fact, we look at it as 3 buckets of GenAI. One is, how can we change the game for our clients, right? How can we deploy or infuse GenAI for our clients? And how can we, our own organization, right? How can we infuse GenAI and create that advantage for ourselves, which could be client zero opportunity, which could be a reference for going forward. The biggest thing that we are, if you look at infusing GenAI for our existing managed services, if you will, it's going to help us on experience, better experience for our clients. It's going to help us on productivity. At this point in time, those are the 2 factors. But on the new deals, we take GenAI into the solution itself, because in earlier deals, GenAI was not there. Now we are infusing GenAI into that. Whereas the new deals, we are going to infuse GenAI.
Rather than moving on from one IT major to another, then IT major Infosys is the next in line to release their 4th quarter earnings. The street is expecting a decline in the revenue when it comes to constant currency or CC terms. What is expected to weigh on the margins? Ansh is joining in yet again to tell us what is being penciled in when it comes to Infosys. Ansh, over to you.
Well, for Q4, revenue in CC terms is expected to decline by 1%, whereas revenue in dollar terms is expected to go down by around 1.4% to $4,868 million. Now, this top line could get impacted from weak seasonality and discretionary spends, also by less number of working days. Also, if you talk about revenue in rupee terms, then that is actually expected to go up by around 1% to 42,198 crore. If you talk about margins, then that is expected to go down by around 80 basis points from 21.3% to 20.51%, and this is mainly due to partial wage hike. Talking about profit, that is expected to go down by around 1.4% to 6,710 crore. Now, if we talk about guidance for FY26, then here we can expect the guidance to be between 2 to 5% in CT terms, whereas margin is expected to remain unchanged to 20 to 22%. Apart from these numbers, there are 5 key things to watch out for. First is management commentary on demand. Second is US and BFSI segment performance. Third is deal pipeline and GenAI impact. Fourth is discretionary spend outlook. And fifth is headcount and attrition trends.
Thank you, Ansh, for sharing those projections as far as Infosys Q4 earnings are concerned. Now, moving on, keeping it with the earnings space, HDFC Life is another earnings candidate, which is expected to see a steady fourth quarter backed by good growth in non-par businesses. My colleague Gaurav joins in to tell us what to expect. Gaurav, over to you.
Well, let's talking about HDFC Life. When we look at 11-month performance of HDFC Life, we've already seen that AP growth has been at around 14% level. And let's also not forget that HDFC Life has also gained market share in terms of AP. But when it comes to numbers, now Street is expecting AP growth for Q4 FY25 as well to remain at around 14%. When we talk about VNB, they are expecting 15% growth in absolute terms. And for VNB margin, they are expecting some uptick in the range of around 30 basis point in terms of VNB margin for the quarter 4. Now, there are certain reasons why brokerages are being a little bullish of HDFC Life, and the reason being that what they believe is that in FY26 we will specifically see HDFC Life being at a better place because ULIPs are actually slowing down. And when we look at portfolio of HDFC Life, they are actually focusing more on non-par products. Other than that, what brokerages are also penciling in is that the FY26 outlook remains a very key thing to watch out for, because when we look at the industry overall for the last 2 years, industry's AP growth has been below 15%. So any kind of commentary of how the AP growth is going to be a crucial thing to watch out for. But at least in terms of numbers, we're expecting a good set of numbers from HDFC Life in quarter 4.
Alright, and those are the expectations when it comes to HDFC Life's Q4. But time now for a very quick breather on the show. When we come back, more news and updates on the other side, so don't go anywhere. Welcome back. You're watching Market Cafe on ET Now with me, Shreyanshi Singh and Kanishka Sarkar, and it's time now to get you the futures and options roundup. In fact, Ansh is standing by with just that.
Well, let's start from Nifty first. As you can see in the chart as well, Nifty has actually surpassed above the 100 DMA, which is 23,400, which was acting as a good strong resistance. So it's a positive thing unless until we stay above that 23,400 mark, which is 100 DMA. Also on option front, we are seeing some put writing happening at the very same 23,400 strike, indicating even option traders are hoping that this level could sustain as a support. Now, if you talk about Nifty Bank, the Nifty Bank continued its up move. It touched this year high. It crossed above that psychological mark of 53,000, indicating very strong positivity in banking space. Also in index future, we are seeing that open interest has gone down by around 1%, indicating good short covering happening. If you talk about index futures, then in the previous session, FII have actually covered some long by around only 99 contract. At the same time, they have covered their shorts by 1,300 contract, due to which the total long has inched slightly from 28.1% to 28.3%. But at the same time, if we talk about retail, then they have covered their long position. Maybe they are getting into profit booking phase here. At the same time, they have covered their short as well by almost same 1,300 contract, and due to which the total long position has gone down from 57% to 56.7%.
All right, then thank you, Ansh. Well, those are the cues we are tracking as far as F&O is concerned. Now, moving on, as we pencil in a start around the 23,360 levels, my colleague Gaurav is standing by with a list of stocks to keep on your radar today. Good morning, Gaurav.
Well, yes. First, let's talk about some of the stocks where earnings will come today. So first, let's talk about HDFC Life, Infosys, Jio Financial. All these stocks are going to be on our radar. HDFC AMC is also one of the stocks in this. Other than that, some stocks will be in our radar, on the back of the corporate announcement. So first, let's talk about IDFC First Bank, Adani Ports, because these companies are going to talk about fundraising during the meeting today. Other than that, Angel One is in focus today, because when we look at consolidated numbers on a year-on-year basis, we saw a very weak set of numbers. Revenue declined almost by 22%, while profitability declined almost by 48%. And one of the reasons was that one-time IPL expense and at the same time lower trading volumes that we have seen. Hero Motors is also going to be in focus today, because company has now stopped their production temporarily for 4 of their production facilities, and that is there in the market. Sonata Software is also going to be in focus on a negative news flow. Now, company has actually cut down their international business revenue growth outlook. What they're saying is that one of their key customers is likely to come up with the low revenue for the company, and that is the reason why high, this company is going to be in focus. Ultratech Cement is also going to be in focus because company has now acquired some stake in the energy company, and this 26% stake will be used for the captive usage of the company. Lastly, let's also focus on Paytm because CEO Mr. Vijay Shankar Shekhar has now voluntarily foregone around 2.1 crores of ESOP shares. Now this is going to cost company as around 490 crore rupees as one-off non-cash expense in Q4 FY25. So definitely watching out on all these counters on the back of the news flow that we have received in the morning.
Thanks, Gaurav, for getting us that list. So there you go. That's the list of stocks that you should be keeping on your radar bright and early this morning. But tell you what, let's start your day right with just some key commentary coming in. So while it's time to be cautious in the market, India seems relatively better placed versus other markets. And that's the word coming in from Jefferies Mahesh Nandurkar. In fact, he also adds that he will stick to domestic facing sectors for now, while also avoiding IT and metals. Let's go across and listen in then.
Not a market, where one can take a very adventurous call. One needs to, sort of take a more measured approach, take a little bit of a cautious approach as well. Evaluate the stocks and sectors more on their merit in terms of what the valuation is, what is the market expecting. And I would say, basically, take a slightly cautious approach. If it goes up too much from here, the market goes sort of too much from here, maybe book profits and buy only when, you see some dips. But that too, I would say in sectors where there are predictability, in sectors where there is valuation comfort, and in sectors, in my view, which are more domestically oriented rather than the global or the outward looking businesses.
How much of the bad news is in the price? It's important for us to look at that, okay, how much of this entire tariff adjustment to global trade and global GDP is something what markets have already factored in?
I think to my mind that to a large extent, those risks, have been factored in, in terms of the sentiments. Obviously, what is not factored in at this point in time is the impact that these tariff adjustments are going to have on the US, in my view, and what kind of a slowdown that will be seen in the US or maybe seen in China, because those are the two economies that seem to get impacted the most. Given the uncertainties around the policies from the US has gone up so much, I believe that US is no longer the most favored destination in terms of incremental flows going forward. And money will be finding its way into non-US assets. For the last few months, barring the last few days, it was Europe and China. But given this tariff war, even Chinese markets have also corrected. So I think non-US markets, non-dollar assets are going to see a positive inflow, and India will get its own share as well. So on a relative basis, I would say it is easier to make a call that Indian market should do better as compared to their other global counterparts. But that could mean that India falls less as compared to the rest of the world. It is not very easy to say that whether Indian markets will rally big time from here on. That's a very difficult statement to make. But so it's a relatively easier, I would say, decision for a global investor as to which markets to own. I would definitely say India is looking far better than many other markets globally. One of the factors that I would say is just the factor, which is oil. So oil prices have come down by almost $15 to $20 from their recent highs. And every $10 decrease in oil prices saves Indian economy $16 billion or nearly 40 basis points of GDP. And we are down almost $15 to $20 on oil prices. So it's almost 60 to 70 basis points of GDP. So whether that reduction in oil prices is passed on to the consumers or whether the government actually levies incremental taxes, on it, but that doesn't matter. The economy is getting that much of inflow, whether the government keeps it or it's passed on to the consumer, that doesn't matter. But that's overall a positive for the Indian economy as such. And so to that extent, I would say the negative impact of the global slowdown or the tariffs can get offset by just this one factor, the lower oil prices. So therefore, I would say that on the relative terms, Indian markets look better. And within the market, I would definitely look at the domestic plays, such as banks or some of the select industrial verticals and so on. Yeah, that's what I would say at this point in time.
Is the selling in IT slightly overdone because we all know the cause and the effect here, whether it is AI or delay in decision making? But the fact that stocks are down 15 to 30% on an average, again, is this the case where all the bad news is in the price?
See, the thing here is that the stocks have corrected, and now many of the stocks are offering a dividend yield of close to 4%. And historically, we've seen the stocks usually bottom at levels like these. Maybe there will be some revision on the downside in terms of the EPS numbers and for the dividend numbers as well. And so therefore, maybe we'll see a slight weakening on the dividend side as compared to the current expectations. So maybe much of the downside is now there in the price as such. From here on, could see some small bit of correction here and there. But is this the time to jump into the IT stocks? My answer would be no, because the multiples, as I said, are at the average levels. The risk is still there on the downside. So as I mentioned earlier, I'm still going to avoid IT or even metals or some of the auto sort of components which are more into exports. So I would avoid all these three segments and focus more on the domestic sectors where I have clearly more visibility and more predictability, and therefore more opportunity for the PE multiples to re-rate.
Mahesh, the SIP flows have been quite encouraging, more than encouraging actually. They have been firm like a rock. And the data which came out on Friday, again, equally encouraging. Can one be reasonably assured that the liquidity crunch what we had in the market because of FI selling and because of what was happening in the global market, that is behind us? Because why would FI sell India? India is where the growth is, India is where the safety is, India is where the tariff impact is lowest. The problem is in US. So one side is SIP flows and second side is prospects of FI selling which will reduce.
Yeah, that's true. So I'm definitely on the more optimistic side here. It's just that I'm not as optimistic as I was, say, like a month or two ago. I mean, I clearly believe that India is definitely a relatively safer place to be in. And as you rightly mentioned, the risks are there more with the other bigger markets like China and US. So that's precisely the reason why I would like to go with banks or NBFCs, which is not only offering the domestic market exposure, but also at a very, very reasonable valuations as well. So as I mentioned, I'll be very careful, in terms of my stock selection, my sector selection, because not everything is going to go up. And my sense is, we just need to make sure that the stocks and sectors that you buy into, are not going to be impacted or not going to be, susceptible to the volatility created by international news flows.
So within domestic, apart from banks, would it be consumption or would it be capex? Would it be consume India? Would it be buy India or build India?
I clearly think that yes, the government capex growth is down for sure. There is no doubt about that. But the private capex is happening in certain pockets in a very, very visible way. And one such sector is power. And I believe that the power sector demand, the power demand has, come back in a reasonably, visible way over the last few months. We have seen February power demand was up 6%, March demand growth was up 7%. And according to the predictions made by the IMD, it looks like that we are heading into a hotter than normal summer, which means that power demand on a YY basis will be even higher as we go forward. And this is not just a near-term call, because I believe that the GDP growth story is intact. And we believe that the power sort of capacity creation is needed in India and is happening, a large part contributed by the private sector. So that is one segment that we like quite a lot. And one can really sort of play that story by way of, power generators, equipment suppliers, financiers, the whole power sector chain. So that looks very, very, attractive story to me. So after the banks and the NBFCs, the third sector that looks no-brainer to me is this entire power sector chain, starting with utilities and, as I said, equipments and the transmission, the distribution companies, and the financing companies as well.
Would you avoid these expensive FMCG stocks? Would you avoid consumer durables with the exception of one or two auto companies? Because while it's a great pitch to buy into consumption, again, the valuations here are just so inflated.
Yeah, so given the volatility that we're looking at, FMCG looks like a relatively safe haven, but that's about it in terms of the story in my view. And maybe the sector does well. I mean, it has done well YTD, by the way. FMCG is down only 2.5%, whereas the broader market is down by much larger number. And maybe over the next 1 or 2 months, as these news flows remain unpredictable, maybe the FMCG sector does well. But I don't really see much larger story in that sector beyond just a defensive bet from a near-term perspective. So the moment I begin to get a little bit more, visibility, one should be trimming down the FMCG. So in fact, in our model portfolio, we are already advocating an underweight stance on the consumer staples. On the durable side, we still like autos. Our preferred bet is two-wheelers. And then among some of the other consumer plays, we clearly like the hospitality sector, the airline sector for sure, the airport sector. So those are some of the names that we like on the consumer side. So yeah. But staples is looking more like a near-term defensive bet, which is something that one can take a look at, but only from a very short-term perspective.
Coming in from Jefferies as far as the current market scenario is concerned and the sectors to keep an eye on. But with that, it's a wrap on this edition of Market Cafe. Stay tuned for more updates on the other side as the market takes all the action forward.